Welcome back, traders and investors, to Benzinga's Pre-Market Prep, brought to you by MarketFi. I'm your co-host, Joel Alconin, along with Brianna Valesky, and we have Sean Emory on the line. He's a portfolio manager at GFG Capital and author of themarketmeter.com. Sean, how you doing here at the beginning of another earnings season?
I'm doing great. What's up, guys?
All right. Well, we got to talk about the hottest stock on Wall Street here, Netflix, trading up 55, 73, 55, 49 here, trading in the 531 handle. The street got it right on this one, Sean. They had been raising price targets and earnings estimates last week, early this week, and they nailed it. Give us your outlook on Netflix.
Yeah, what a move. Yeah, looking at Netflix, it's up 12%, 13% in the pre-market. And honestly, I don't get it. If you look at the numbers alone, this was the biggest miss since 2004 on a quarterly basis. So clearly the market's focused on something else, and that something else is subscriber growth. Just to look at that, when they missed in the third quarter of last year, the stock was down 19%. When they beat in the fourth quarter of this year or last year, the stock was up 17%. So it's very much focused on subscriber growth. But I think I look at subscriber growth or the numbers a little bit differently. So they're growing global subscribers at 29%. That number on an absolute basis is great. But this is down from 40% just 2 years ago. So I think Netflix as a whole, they're doing a fine job. They got the technology spot on. Content is working today, but I think this is a content company. Some people want to put it in the technology camp, but it's a content company. As competition creeps in, meets the same technology that Netflix is doing, it's going to come down to content, making your viewers happy. And when it comes down to price, I just can't see myself paying 61 times EBITDA. I think that's a stretch. So you don't see me getting involved from a fundamental standpoint in a company like Netflix. I think it's a great value in the Netflix service, but I think there's no value in the stock today. So that's really how I see Netflix from a fundamental lens. Technicals is a little different story, and we can talk about that if you'd like.
Okay, let's hear. I mean, first, would you be tempted to short it? And second of all, let's talk about the technicals.
No, so I would. My motto is never short a good company, never short a good product. That just doesn't make sense to me. I mean, Netflix again is a great service. I use it. I think there's more people that I know that don't, or less people that I know that don't use it than the opposite. So I would never short a company like Netflix. I see some of the bears out there saying that they're short, and I just think that's a losing battle. From a technical standpoint, I mean, going into this earnings report, we were just below that 489 peak seen last August. And I think here on the breakout, I wouldn't play this breakout, but if this exhausts somewhat, I think you would want to own it above that 490 level, and that's where I would own it. So that's the beauty of what I try to do is fundamentally I don't want to get involved, but technically the market's saying something completely different. So if the market's saying something completely different, let me just listen, and I can get involved on the technical side and not have to worry about some of the things that I'm talking about, 61 times EBITDA, and some of these other metrics that just don't make me feel comfortable at night when, as a value type of investor searching for growth.
Okay, well, you got a favorable move from Blackstone Group here. I know that's in your portfolio here. Bursting to new all-time highs here. We hit 43.34 in the pre-market trading above pre-market high. Are you apt to kind of sell the news on this one, trim the position, take a little profits, or is this just a breakout? You're just going to keep holding long-term in your portfolio?
Yeah, hold, buy. That's the motto here. Blackstone continues to crush it. $290 billion in AUM last quarter. Now they have 310. If you look back, they had $128 billion in just 2010. So 5 years, They went from 128 billion to 310. So that's enormous growth, enormous comfort from investors globally and just trusting Blackstone with their assets. Income came at 162 billion or 1.62 billion, sorry. And if you look at earnings over the last 5 years, they've compounded that by 46%. So that's a great number. This quarter alone, I was just running through the numbers. They raised 30 billion in new assets. So take that compared to its peers, all the rest of the alternatives or the alternative managers. They raised 30 billion, and that's more than any other alternative manager raised in the single year last year. So they're doing that in a quarter. And no one really talks about Blackstone as an innovator. And I truly think they are an innovator, a financial innovator. 50% of their assets or their AUM is in products that didn't even exist 7 years ago. So that's something that I pay close attention to. They're continuously innovating. So they had a phenomenal quarter, something we want to hold here. Technically, we started to add to it once it was breaking out above its IPO highs. So 7 years ago it IPO'd pretty much at the exact wrong time. And it fell down. We started buying it in the 20s, and right around 35, 36, 37, we were continuously buying. So we're not buying this move per se, but we were buying 6, 7, 8% ago. So I see this as a long-term story, and technically it looks great too.
Okay, Goldman Sachs, good earnings today, back over 200 for the first time since the financial crisis. Had a nice rally going into the earnings here. Did trade up to 205 in the pre-market here. What do you think? We're going to hold 200 here for next couple days and make another run up in Goldman Sachs?
Yeah, so technically that's where you want to own it, above 200. That's a psychological support level. The highs were roughly at the 198, so you got two things going in your favor. So if you were going to own Goldman Sachs, that's exactly where I'd want to own it. Again, like you were saying, earnings were impressive. Broad-based, each unit performing at a high level now. Income was up 40%, revenue up 14%, bond trading and equity trading was really the highlight. Everyone was kind of forgetting or dismissing that they could regroup and the trading would pick up, and that would be a nice driver for returns. I don't get particularly excited with Goldman, and that's just because I'm looking at the ROE number. I don't think they'll ever get back to the 06, 07 levels, and it all comes down to leverage, which will enhance their profitability, and leverage is down 61% since their peak times. So from looking at a company, trying to get excited about a company, Goldman doesn't really resonate. At 1.2 times book, it's not expensive. So I think it's something that if you're a long-term holder and somebody that is seeking some sort of safety, Goldman's a pretty good company to own, and technically you want to own it again above these 198 or this 200 level. As opposed to anything below that. I wouldn't be an owner below that 200 level. But again, I'm not that excited on the upside either. I think this is something that will compound for a long-term investor as opposed to anything that excites me today.
Nice move in some of the European bourses here. QE getting rolling over there, Draghi style. Is there anything that you still have some room to run as far as the European bourses go?
Yeah, year-to-date's been a European rally, in euros, of course. So if there's been one forgotten nation, and I'm looking at for a mean reversion trade, over the last 5 years, Germany, Europe as a whole has been up 50, 35% respectively, but Italy is the one I'm looking at. EWI is the ticker if you want to do trade it broad-based. That's down 7.84% over that same time. So you have a gap of 40 to 50%. One of the key things there is some of the broader macro thinkers are looking at the youth unemployment, 42.6%. Sure, that's a problem. But when you look at the chart, EWI has made a series of higher lows since January, and we're looking to make a higher high. If we can do that, or we have just done that, we broke above 15. It's trading at 15.20 roughly. If we can hold kind of the 14.75 level, you want to own Italy in a mean reversion trade. I think that is the forgotten name, and if you're trying to own Europe, go to Italy. Don't chase Germany. Don't go broad Europe. I would go to Italy. I think it's been the forgotten name, and technically it sets up pretty well. Your risk-reward is pretty well defined.
And a couple things of note here. I got the weekly chart pulled up here, and you might have a head and shoulders bottom here to take a look at. You might also have a long-term breakout over the $15 level, which has kept a cap on rally since October. So kind of have to agree with you on that one. Just real quickly, you mentioned a term there, mean reversion. It's probably self-explanatory, but could you just put it in your own terms for our listeners?
Yeah, so when you look at markets that are highly correlated, things that usually trade in unison. For example, the U.S. stock market, large caps and small caps are typically going to head in the same direction. Over long periods of time, they're going to be trading in very typical manner or similar manner. So I'm looking at Italy versus its European peers. Historically, they've traded in unison. They've traded together. But over the last, I'd say 2 years, 3 years, 4 years, Italy has broken away. Some of it is macro-driven, but over longer periods of time, this relationship tends to come back together. So when I'm looking at Italy versus Germany versus Europe, I'm looking for Italy to get back to normal and trade closer to its peer group and not stay in this kind of divergence that it has been over the last couple of years.
Okay, let's talk oil here a little bit. Big rally over the last couple days. Got up over the $56 level. I mean, you could talk about a mean reversion in that route. In oil, it could be back at $70. But you've been picking on Halliburton. Give us your take on Halliburton here. And here's another, at least on the weekly here. This thing kind of has not such a head and shoulders pattern, but a nice rounding bottom here. Talk about Halliburton and your short and long-term expectations for it.
Yeah, so we like the company long-term regardless of the technicals today. But in December, we started, last time we spoke, or the time before that, 2 times ago, but we started talking about Halliburton. It was getting interesting fundamentally. We wanted the technicals to line up. We wanted that bottom to form, momentum turn our way, so we could start getting really excited about it. We started to see that transition. And sure enough, we made a series of higher lows. And dating back to roughly February, we took out recently those February highs. That was when we started even adding to our position as you had kind of an ascending triangle. We think that regardless, we're not looking necessarily at oil. Arguably, they're going to move pretty similarly. Because there's obviously some correlation there. But when we look at Halliburton, technically it's breaking up above those February highs. We were buying this a lot cheaper in the 38s, 39s as we were seeing this bottom forming. So we started to get involved there and have really been buyers ever since. And you would want to hold it pretty much above these 47 level that we saw the breakout. Anything below that, you could see a nice reversal. Again, we wouldn't be on the short side because we like it fundamentally. So we're holding our long-term piece of our portfolio. But then this addition is pretty much a technical play above that 47 level. So that's how we view Halliburton.
Before we let you go, general market, pretty boring here. S&P's knocking on the door, all-time highs here. Coming into earnings season, what do you think? Is this the earnings season is going to push us up to new all-time highs and beyond, or are we just going to stay in this long-term consolidation pattern in the S&P 500?
So as a bull, I'm hoping we take out the highs, but it's been pretty boring, the S&P. Like you were saying, we've just been rubbing up on these highs. I won't get excited until we rub up or break above these highs. Earnings season is the focal point, in my opinion. Consensus estimates have come down significantly. I think that the market is going to beat those estimates handily. We've done that year over year, especially in this quarter. It's kind of been the same thing, the weather story, this and that. So when I look at the S&P 500, it's hard for me to believe that the S&P 500 is going to stay below here when you have small caps and mid caps continuing to break out some new highs. So broad-based, I want to see the S&P break out to the upside. If it doesn't, it doesn't really matter because I'm getting involved in single names right now. Until I see a broader rally, I'm not necessarily going to get involved in kind of a broad index like the S&P 500.
Okay, Sean Emory, portfolio manager at GFG Capital and author of themarketmeter.com, joining us on today's show. Sean, thanks for the insight. Have a great day, and we'll talk to you again soon.
All righty. Thank you. Have a good one.